So, how does a bank actively lower the interest rates it pays out to its depositors, yet somehow convince those exact same customers to, entrust them with even more money?
Right. I mean, it sounds like a complete paradox when you first hear it.
Yeah, it really does. Because if you read the financial headlines lately, you would think regional banking is just, well, inherently unstable.
Oh, absolutely. The public narrative heavily implies that mid-sized regional banks are constantly teetering on the edge.
Exactly. You see these stories about deposit flight or customers chasing like 5% yields at the online mega banks. And regional institutions are supposedly just struggling to keep their margins intact.
Yeah, the assumption is that they're vulnerable to every slight shift in interest rates or, every nervous depositor looking for just a fraction of a percent more in yield.
But then, if you look past all that noise and you dig into the actual SEC filings, you find a regional bank executing a strategy that just entirely defies that narrative.
And that brings us to the mission for today's deep dive.
Right. We are looking at a very specific case study for you today, which is the Q1 2026 earnings report from Hanmi Financial Corporation, the parent company of Hanmi Bank.
And we are not going to just dump a spreadsheet of metrics in your lap. That's not the goal here.
No, definitely not. We want to decode the actual mechanisms, the how and the why behind their ability to grow profitability, manage risk, and basically retain a fiercely loyal customer base in a really fractured banking environment. So, okay, let's unpack this.
Well, I think we should start by setting the baseline of their performance because the numbers themselves really dictate the strategy we're going to break down for you.
Yeah, let's look at the delta, the change from the previous quarter.
Yeah.
Because Hanmi posted a very solid Q1. Net income was $22.6 million, which breaks down to 75 cents per diluted share.
Right, but the standout metric there is the growth. I mean, that net income is actually up 6.2% from the previous quarter.
Exactly. And looking at their efficiency, their return on average assets, or ROAA, hit 1.18%, and return on average equity was 10.86%.
Which is really impressive for anyone tracking bank performance. Hitting an ROAA of 1.18% in this current macroeconomic environment is just an elite metric.
Wow, really? So 1% is usually the goal?
Yeah, historically, a 1% return on average assets is considered the benchmark for a highly functional, highly profitable institution. So pushing past that to 1.18%, I mean, that isn't an accident of the market.
It takes actual work.
Exactly. It requires aggressively managing the spread between the cost of your raw capital and the yield on the financial products you sell. They're successfully pulling off this really complex operational balancing act.
And that spread you just mentioned, that is really the core engine of any bank. It's the net interest margin, or NIM.
Right, the NIM.
To make NIM tangible for you, I like to think of it kind of like a manufacturing supply chain. A bank acquires raw materials, which is the cash you and I put into our savings accounts or CDs.
And there is a cost to acquire that raw material, namely the interest rate the bank pays us.
Exactly. So the bank then takes that raw cash, repackages it, and sells it as a finished good, like a mortgage or a commercial line of credit. The interest they charge the borrower is the retail price.
So the net interest margin is just the profit margin sitting between the cost of the raw material and the yield of the finished good.
Right. And what's fascinating here is the specific mechanism Hanmi used to expand that margin. Their NIM actually increased by 10 basis points in Q1, bringing it up to 3.38%.
Which is a solid jump, and total net interest income grew to $63.2 million.
But usually, when a bank wants to widen its margin, the brute force method is to just aggressively hike the rates they charge their borrowers, right?
Yeah, that's the standard playbook. But doing that runs the risk of pricing yourself out of the market entirely, or worse, forcing your existing borrowers into default.
Right, which you don't want. So Hanmi took the opposite approach. They expanded their margin primarily by lowering the cost of their raw materials.
And the data shows that so clearly. The average rate Hanmi paid on their interest-bearing deposits dropped by 16 basis points, bringing it down to 3.20%.
But wait, this brings us right back to the paradox I mentioned at the top of the show. If they are actively dropping the interest rates they pay out to customers, why aren't those depositors pulling their funds and moving to a competitor offering a higher yield?
It's a great question, because we are constantly told that modern banking customers are just ruthless rate chasers.
Right, exactly.
To answer that, we really have to look at the structural composition of their deposit base. Because despite dropping their payout rates, Hanmi actually grew their total deposits by 1.8%, hitting $6.8 billion.
Wow. So they lowered the cost of capital and simultaneously increased the supply of it.
Exactly. It's an incredible move.
I noticed a specific statistic in the breakdown of that 6.8 billion that seems to explain this, though. Roughly 30% of Hanmi's total deposits are non-interest-bearing demand deposits,
Yes, that is the key right there.
meaning nearly a third of all the money sitting in their vault pays absolutely zero interest to the depositor. How is that even possible?
Well, for a bank, a 30% non-interest-bearing deposit ratio is basically the holy grail of funding. It's
Yeah.
essentially free capital that the bank can deploy into yielding assets.
Free money, basically.
Pretty much. But to understand why someone leaves millions of dollars in an account earning 0%, you have to look at who these customers actually are.
Okay, so who are they?
These are not retail customers looking to maximize a personal savings account. These are mid-sized operating businesses.
Oh, I see. So I'm picturing like a regional manufacturing company or maybe a massive logistics firm. They have really complex daily capital needs.
Exactly. Consider a company with a $5 million biweekly payroll, right? They're receiving daily wire transfers from dozens of vendors and constantly executing automated clearinghouse payments for raw materials.
So they can't just lock their operational cash in a high-yield 3-month CD.
No, not at all. They need immediate liquid access to those funds to keep the lights on. But more importantly, the bank provides the software, the treasury management systems, that routes all those complex payments.
Ah, so the business values the operational utility and the software integration far more than they value a 3 or 4% yield.
Precisely. The friction and the operational downtime of moving their entire payroll and vendor payment system to a new bank just to chase a slightly higher interest rate, well, that would cost them infinitely more than they'd ever gain in yield.
That makes so much sense. The relationship becomes deeply entrenched. The bank's software is essentially integrated into the operational plumbing of the business.
And we can actually verify that Hanmi is relying on these sticky relationships rather than volatile rate chasers just by looking at their brokered deposits.
Right. Broker deposits are basically hot money, right?
Yeah, exactly. They're expensive short-term funding that banks buy through third-party financial brokers when they're desperate to shore up liquidity. Hanmi's broker deposits sit at a microscopic 1.3%.
That's practically nothing. Now, balancing that out, there's another metric in the sources that immediately caught my eye. Hanmi's estimated uninsured deposits are sitting at 44.4%.
I know where you're going with this.
Yeah, because for anyone who watched the banking turbulence last year, the phrase uninsured deposits triggers immediate alarm bells.
Right, it sounds terrifying.
But given what we just discussed about these massive operating accounts, my read is that this 44.4% isn't actually a vulnerability. These are just standard commercial accounts that naturally blow past the $250,000 FDIC insurance limit just to meet basic payroll requirements.
That is the critical distinction you have to make. An uninsured deposit base consisting of panicking, high net worth individuals is a massive flight risk.
Right.
But an uninsured deposit base consisting of thousands of operating businesses using your treasury management services daily, that is incredibly stable.
Because those businesses aren't going to pull their operating capital in a panic. Doing that would instantly halt their own business operations.
Exactly. It's a completely different risk profile.
Okay, so Hanmi has successfully built this fortress of $6.8 billion in highly stable, relatively cheap capital. The immediate logical question for you as an investor is, well, how do they deploy that money into the market without taking on unnecessary risk?
Oh, well, you have to originate loans. But the story of their first quarter isn't just about the sheer volume of the loans. It's entirely about the pivot in their loan mix.
Yeah, loan production overall was healthy, increasing to $377.9 million. But diving into the categories, here is where it gets really interesting.
It's a huge shift.
Commercial and industrial loan production, what the industry calls C&I loans, surged by 64% in the quarter. C&I loans now make up 17.6% of their total $6.55 billion loan portfolio.
It is a profound strategic shift. Historically, regional banks have been overwhelmingly reliant on commercial real estate or CRE loans.
Like financing shopping centers, office buildings, apartment complexes, that sort of thing.
Right. But the CRE market is currently facing massive headwinds. Property values are compressed, and refinancing at these higher rates is really difficult for borrowers.
I view this pivot kind of like well-established restaurant realizing a vulnerability in their business model.
Oh, I like this analogy.
Let's say a restaurant makes 90% of its revenue from a massive dinner service. That's highly profitable, right? But if a sudden trend impacts dining out at night, their entire revenue stream just collapses.
Right, they're too concentrated.
Exactly. So to protect themselves, they aggressively build out a robust, high-volume lunch service to diversify their income.
Hmm.
For Hanmi, commercial real estate has been their dinner service.
Yes.
And to mitigate the current risks in the CRE market, they are rapidly building out this massive lunch service in commercial and industrial lending.
That's a perfect way to look at it. And if we connect this to the bigger picture, the mechanics of a C&I loan are vastly different from a real estate loan.
How so?
Well, a C&I loan is not backed by a static building. It is a loan made directly to a business for operating purposes. It's a line of credit to finance a sudden surge in inventory, or maybe an equipment loan to buy 10 new delivery trucks because the company is expanding.
Got it.
And these loans are typically shorter in duration and often feature floating interest rates, which protects the bank's margin if the broader REIT environment shifts.
And it feeds directly back into the deposit strategy we were just talking about, right?
Yes.
Because if Hanmi extends a $2 million C&I line of credit to a logistics company so they can expand their fleet, part of that lending agreement almost certainly involves that logistics company bringing their primary operating deposits over to Hanmi.
It creates this closed-loop, self-reinforcing system of relationship banking. The lending provides the yield, and the borrower provides the low-cost, non-interest-bearing deposits that fund the very next loan.
It's a brilliant cycle. And Hanmi is utilizing this surge in C&I production to actively upgrade the overall yield of their portfolio. The sources detail a really clear swap of assets.
Yeah, the new cargo versus the old cargo.
Exactly. The older loans that naturally paid off and left the portfolio in Q1 had a weighted average interest rate of 6.21%. But the new loans they originated during the quarter carry a significantly higher weighted average rate of 6.54%.
Right. They are systematically flushing out lower-yielding assets and replacing them with higher-yielding commercial loans.
Which perfectly explains the mathematical expansion of that net interest margin we analyzed earlier.
Yep.
They lowered the deposit costs by 16 basis points and raised the incoming loan yields by over 30 basis points.
The core engine is operating at maximum efficiency.
However, I have to be honest, whenever I see a bank rapidly expanding a specific lending category, like a 64% jump in C&I production, my immediate concern is underwriting discipline.
Sure, because rapid loan growth often masks a loosening of credit standards.
Exactly. If a bank wants to originate that many loans quickly, the easiest way to do it is just to lend to riskier borrowers. So we have to look at the asset quality to see if this growth is actually safe.
Because a wide profit margin is completely useless if the underlying loans start defaulting. The provision for credit losses will instantly wipe out the net income.
Right. But looking at the macro level of their asset quality, the numbers are incredibly reassuring. Non-performing assets plummeted by 38.3% compared to the previous quarter.
That's a massive drop.
Yeah, they are down to just $12.4 million. And to put that into scale for you, $12.4 million represents just 0.16% of their total assets.
Wow.
Similarly, non-performing loans sit at a microscopic 0.19% of their total loan portfolio.
Yeah, I mean, at those percentages, the portfolio is essentially pristine. There is no systemic distress visible in those top-line numbers at all.
But digging into the subcategories, I did find a potential crack. Criticized loans actually increased by $19.4 million during the quarter.
Ah, okay. This raises an important question, though. In bank examination terms, a criticized loan isn't necessarily in default.
Right, it's just flagged, right.
Exactly. It's a loan that internal risk managers or external regulators have flagged as exhibiting potential weaknesses that require closer monitoring. So when you see a $19.4 million jump in that category, you have to determine if you are looking at dozens of small businesses suddenly struggling with cash flow, or if it's just an isolated anomaly.
And the earnings details provide the exact autopsy on that number. The entirety of that $19.4 million jump was driven by a single loan.
Just one.
Just one. One $21.2 million commercial real estate loan in the retail sector was downgraded to special mention status.
Okay, so a special mention classification means the borrower is currently paying But there's an emerging trend, maybe a major tenant in their retail center didn't renew a lease or something that could jeopardize future payments.
Right.
But the key takeaway here is isolation. In a total loan portfolio of $6.55 billion, an increase in criticized loans driven entirely by one idiosyncratic real estate deal proves that the broader underwriting standards across the other thousands of loans are actually holding firm.
That's a relief.
Yeah.
Now, beyond just managing the interest spread and the loan risk, the Q1 report highlights how they are generating revenue outside of their traditional lending operation.
Right, their fee income.
Yeah. Their non-interest income features a really interesting mechanism. Small Business Administration, or SBA, loan sales. Hanmi generated a $2.1 million gain simply from selling SBA loans in the first quarter, backed by a very strong trade premium of 7.88%.
The mechanics of the SBA secondary market are just a fantastic example of operational hustle.
How does that actually work?
Well, when a bank originates a loan backed by the Small Business Administration, the government guarantees a large portion of that loan, often up to 75%.
Okay.
And because that guaranteed portion carries the full faith and credit of the U.S. government, it is incredibly attractive to institutional investors who want a safe, steady yield.
So Hanmi originates the loan, helps the small business get their funding, and then immediately turns around and sells the government-guaranteed portion of that debt on the secondary market.
Exactly. And because the yield is so safe, the institutional investor pays a premium for it. In this case, nearly an 8% premium. So Hanmi books that $2.1 million premium as immediate pure fee income. It drops straight to the bottom line. And they get that cash without having to tie up their own capital, holding the full loan on their books for the next 10 years.
And they still keep the relationship with the customer, right?
Yeah, they typically retain the servicing rights, too, meaning they maintain that daily relationship with the small business customer.
So what does this all mean? We have a bank that has lowered its cost of funds, grown its sticky commercial deposits, rapidly diversified its lending into higher-yielding C&I loans, maintained pristine asset quality, and is just hustling on the secondary market for fee income.
Right.
How does that flawless execution actually translate into value for the people who own the bank, the shareholders?
It translates directly into capital accumulation. When a bank operates with high net interest margins and virtually zero credit losses, the profits compound rapidly, building up the institution's capital ratios.
And the metrics really reflect that buildup. Hanmi's tangible common equity to tangible assets ratio improved 12 basis points to 10.11%, and their common equity tier 1 capital ratio, often just called CET1, rose to 12.20%.
For context here, CET1 is arguably the most critical measure of a bank's financial resilience. It represents the highest quality of regulatory capital, primarily common stock and retained earnings.
The actual safety net.
Exactly. It is the core financial shock absorber that can take a loss without forcing the bank to halt operations. Pushing CET1 to 12.20% means Hanmi has accumulated a massive buffer.
So they've fully funded their own loan growth, covered their operational costs, and still have a significant pile of excess cash sitting on the balance sheet.
Yes. And when a bank has excess capital and no immediate internal need for it, the textbook move is to return it to the owners.
Which they did. In the first quarter, Hanmi returned $13.4 million to shareholders. They paid out $8.6 million in direct cash dividends, which comes out to 28 cents per share.
Nice.
And they took the remaining $4.8 million and executed share repurchases, going into the open market and buying back over 185,000 of their own shares at an average price of $25.89.
Executing share repurchases at that level is just the ultimate corporate signal of confidence. Management is essentially auditing their own loan book, looking at their deposit stability, and deciding that the public market is heavily undervaluing their stock.
Right. They are telling investors that the safest, most lucrative place to deploy $4.8 million of capital is simply to buy more of their own business.
It perfectly ties together the entire strategy we've decoded today. You keep your funding costs incredibly low by focusing on the operational utility of your treasury management systems, securing millions in non-interest-bearing commercial deposits.
Yep.
You aggressively pivot your lending away from vulnerable commercial real estate and build a massive new revenue stream in commercial and industrial loans, upgrading your yield in the process.
And you enforce rigorous underwriting so your non-performing assets remain microscopic. And you use the resulting excess capital to continuously buy back your own stock and pay dividends.
The execution of the Hanmi playbook is deeply impressive. But studying this specific earnings report forces us to reconsider a much broader assumption about the current economic landscape.
Oh, where do you see the broader implication?
Well, we consume a daily diet of financial media that hyperfixates on the vulnerabilities of trillion-dollar mega banks or, the localized crises in downtown office real estate.
Right. Doom and gloom, mostly.
Exactly. But consider what a 64% surge in C&I loan production actually represents in the real world. It means that mid-sized businesses, the manufacturers, the logistics firms, the local distributors, they are actively borrowing operating capital at 6.5% interest rates.
Because they see enough consumer demand and growth potential to justify the expense.
Yes. If a regional bank like Hanmi can find that much high-quality loan demand from everyday operating businesses, it strongly suggests that the hidden underlying foundation of the mid-market economy possesses a quiet resilience that the screaming headlines are entirely missing.
That is a fascinating takeaway. It really reinforces the value of doing a deep dive into the primary sources.
It really does.
Because when you finally stop looking at the chaotic, macro-level weather radar and examine the actual X-ray of a disciplined regional bank, you realize the foundation is far stronger than the public narrative wants you to believe.
Absolutely.
Well, thank you for joining us on this deep dive. Keep questioning the consensus. Always look at the underlying mechanics of the numbers, and we will catch you next time.